So Karan, this video we are specifically making for a lot of our NRI customers and even potential ones who are quite keen on knowing how to increase or when to increase their India exposure. So one of the things that they ask us repeatedly is that, especially in the next 18 to 20 months, what are some of the macro signals or trends specific to India that they can probably watch out for?
Santosh, this question has come up because of underperformance of Indian markets in the last 12 months. Okay. So if you look at if you compare dollar returns, against US and China, we are underperforming US by around 20 to 30% just in last 12 months.
Okay.
China, 60%.
Okay.
So the big gap is there. If you look at Korea, Japan, everywhere we are underperformed. We are laggards in the last 1 year.
Right.
But I think people should zoom out a bit. Okay. In last 5 years, we are still outperforming US markets. In last 5 years, we have given, say, 70%, Indian markets have given 70% returns.
Right.
Okay, in absolute terms. Okay, in USD, while China is still negative.
In the last 5 years.
Last 5 years, despite massive rally in last 1 year.
Okay.
So people are bothered too much about short-term trends. Okay. When it comes to India, India is a long-term story. Okay. So today, every year, world adds 4 trillion to global GDP.
Right.
Okay. Out of that, 400 billion comes from India.
That's 10%.
That's 10%. Okay. Now, if you look at the IMF estimates, we are supposed to double our GDP every 7 years. Okay. So today we are 4. We should supposed to become 8 by 2032, 16 by 2040.
Right.
Okay. So this ratio is going to increase to 25% in next 5 to 10 years.
Right.
Okay.
Right. So essentially, what you're trying to say is that especially when it comes to an NRI who probably already has some sort of a home base in India, they are anyways wanting to increase the exposure, but this question that is entering their minds is largely because of
the last 12 months.
The last 12 months.
Just last 12 months. And you talk about some of the signals that can be there. Okay. The most critical parameters that people look when they're selecting a market, whether it's NRIs or other categories like FIIs and all, they look at, first of all, relative valuations. And second thing is technical indicators.
Right.
Okay.
Right.
Technically, whenever US-India market gap, first of all, people believe that markets move together.
Right.
US and India are perfectly diversified markets. Okay. Apart from extreme market moves, extreme market downside moves, when correlation increase, there's been a very low correlation of around 0.2 or 0.3. So anyway, NRIs across the world should add India.
Right.
India is going to be the center of global growth with 20-25% growth coming from India. So there should be 20-25% allocation to India anyways.
Right.
Across the board. It's a no-brainer.
Right.
Okay.
Right.
Now coming to US-India correlation. Okay. From 2000 to 2010, India returned around 500% returns. Okay. On USD terms.
Okay.
US delivered 0. In the next 10 years, 2010 to 20, in US dollar terms, India delivered only 25% returns. US delivered nearly 400. So they move in different directions. So anyway, when it comes to diversification, when you look at even if you look at India, US and China, they move together to a large extent because of large export
dependencies.
Okay. US and Europe always move together in general. Okay. So India is a perfect diversification. Anyhow.
Right.
Okay.
Right.
In past 25 years, whenever India-US gap has increased to 20% or above in favor of US, in next 24 months, India has outperformed by nearly 20-30% in USD terms. That's a given.
So one thing which I wanted to touch upon here, Karan, especially in the world, the way it is changing in the recent past. And when I say change, I don't only refer to Trump and his tariffs and his other policies, but even when it comes to technological changes like AI. Now, I know it is too much of a buzzword right now to be thrown around, but if you look at the India story, like you said, one of the biggest drivers of our growth has been the service-led exports that has actually fueled our growth in recent times. Now, if AI is likely to kind of eat into that pie, won't that in some way affect the India story over the next 10 years or so?
Santosh, it's not like that world is changing for first time.
Right.
World has always been changing after a few decades. There's been, after every 20-30 years, there's been a new mega trend and that has changed the world. Okay. 70s it was oil. Okay. In 90s it was internet.
Correct.
Okay. Internet, if you look at the history of internet, most of the investment was made in developed markets. US, Japan,
correct.
Okay, West Europe, Nokia was the largest phone company till 2008. Even outside US, it was concentrated in developed markets mostly. Okay. 90s saw massive boom in US. Okay. was dot-com bubble. Okay, stock market gave massive returns, or still to the tune of 10x.
Right.
Okay, in the 90s only. US dollar index went from 72 to at the beginning of 90s 72 to 120. Okay. That time also, when computer was here, internet was coming, people were under the impression that there might be job losses.
Right.
There were concerns were there. How would India deal with it? But eventually, India banked on its talent pool, okay, in a large consumer market, and it was the main beneficiary of that internet boom. We never saw the prosperity and boom that we saw in last 25 years of internet has been unprecedented.
Correct.
In last 1,000 years, I would say.
Yes, agreed.
Okay. So if you say that, okay, these are early days in AI, okay, and if I want to invest in AI, I'm looking for that particular theme. Massive investments would be made only in Japan, Korea, Taiwan, China, US, Europe, because their companies have massive surpluses.
Correct.
Okay, running in hundreds of billions. Okay, so they can make massive investments. Okay, there. Initial days, yes, these might be painful. Okay, even in internet days, initial internet days, the period from 98 to 2002 was painful.
Yeah.
So we have been still in initial stage.
Right.
Initial when talks about AI started in 2018-19 becoming mainstream, we saw a spurt in IT employment.
Right.
And service exports also increased. There might be a blip in next few years. Companies are focusing more on making investments.
Correct.
Rather than business as usual, rather than BAU.
Yeah.
But eventually, once investments are made, focus would shift on application, sustenance, and maintenance.
Right.
Okay.
Right.
And that might fuel a next leg of growth.
So if I hear you correctly, what essentially you're saying is that yes, because of this change, like all changes historically, there can definitely be some sort of a short-term impact. There is no denying that. But eventually, over time, purely on the basis of our talent pool, our overall demographics, and the sheer numbers that we actually have, we are likely to find that sweet spot, which again reignites the growth that will take.
See, India has the still, despite low birth rates and everything, India has the fastest growing demography in the world, in the G20 countries. It's the largest market. It's the largest pool of internet users. Okay, in the free world, we can say.
Yeah.
Okay.
Yeah.
It has largest number of mobile users consuming mobile data. These companies have to sell product somewhere. True. Eventually, the focus would shift from investments to monetization.
Yeah.
And at the monetization stage, India would be in sweet spot.
Yeah. Would it be also right to at least add a couple of caveats at the end, saying that this is where a government initiative also will play a huge role over the next 10-15 years? Because one of the data points which is actually quite worrisome for India is that almost 75% of graduates that come out of Indian schools and colleges, they are almost unemployable. That is actually a fact. So when it comes to, yes, we have the numbers, but we certainly don't seem to be, as of now, investing in human capital.
See, the thing is, yesterday I was reading a transcript of an interview of Ray Dalio. He's a big hedge fund manager.
Yeah.
Okay, he was saying that 60% of Americans have not got education beyond 6th standard.
Right.
Okay. Very few Americans actually go for graduations and post-graduations. But America spent a lot of money on research R&D. Okay. The R&D, if you look at the do apple-to-apple GDP comparison of R&D, we are doing 1/10.
Right. We are very poor. I think 0.5, 0.6.
0.6%. Normally, it's 3 to 5% is a global norm.
Yeah.
Okay,
China is 4 times of.
4 times of it.
So this makes sense from the India story perspective. Are there any other signals that NRIs could possibly watch out for?
Trailing 12-month basis.
Right.
If US-India performance is in favor of US by 20% or more, it's ideal time to increase allocation to India for next 3 years.
From a reversal standpoint.
It has happened 5 times in the past. We are right now at this stage only. It has happened 5 times in the past. 100% of times, India has outperformed over next 2-3 years by a good distance. I would say 20 to 40% in USD terms. Okay. And in four times, it was a bear market in US.
Right.
Okay. Only one time, it was due to positive outperformance from India.
Okay.
So it's actually good time to reallocate from US to India to protect against impending bear markets. It's typically bear market signal for US.
Right.
Okay. Second, the most important parameter is valuation.
Okay.
Nifty 50 PE ratio. It's easily available on Nifty
Yes.
NSE website. Okay, you can monitor it. You can see the historical values as well. Traditionally, FIIs, I will not say traditionally, I will say in last 15 years.
Okay.
FIIs have entered India whenever they have the valuation comfort.
Okay.
So valuation comfort means TTM PE ratio goes down to 20 or below.
Right.
Okay.
Right.
For example, since 2015, they've been selling Indian market. They entered just after COVID when valuation went down to 16x.
Right.
From 28x.
Right.
It was just
Right.
before COVID crash. It was 28x. It went down to 16x.
Right.
Even in recent, when there was a meltdown in March, April 2025 due to Trump tariff, FIs were continuously selling for last 6 months. They were massive selling, unheard of selling.
Correct.
So selling started when PE ratio was at near 25.
Okay.
FIs entered
In the
again
recent times, you mean?
in September 2024.
Okay.
And they entered again when valuations touched 19x in March.
Okay.
So today valuations are around 23x, which are not very comforting,
Right.
to say the least.
Right.
But having said that, entire world is costly right now. If you look at US, is trading at 30x. It's nearly 50% above the historical range.
Right. Yes.
If you look at Japan, China, Korea, Europe, everybody is trading on at least 30 to 40% above their historical range.
Okay.
India is still in line with historical range. Okay.
We're not terribly expensive yet.
We are not terribly expensive. So typically a market outperform in two conditions. Either there is a valuation room.
Right.
There is room for valuation expansion.
Correct.
Second is EPS growth. Okay. So EPS growth is a bit technical in nature. Okay. As of now. But if there is a crash in US, let's say in next 3 to 6 months,
right.
Okay, there will be corresponding impact on India as well. Okay. And that will give a valuation comfort in fastest growing economy in the world.
Got it.
And I think investors should grab that if that opportunity comes with both hands. If anything goes below 20x or below, it's a catch.
Okay. Now, coming especially from an NRI perspective, one of the key dimensions that gets added for their investing is the currency risk. So, what can be some of the practical ways that a typical NRI investor looking to increase India exposure should try and hedge against a currency risk?
So, let me give you a perspective on currency risk. Okay. So, you would not believe, but I just told you returns for decade of 2010s.
Right.
That was around 20-30%.
Yeah.
Okay. You know, in Indian currency terms, it was 100%. In INR terms, it was 100%.
Okay.
Such was the massive impact of currency depreciation that it nearly ate into half, I would say, nearly 2/3 of returns.
That's serious damage.
Currency depreciation is a real risk.
Right.
I would not deny that. Okay. And normally investors lose, even in good times, 2 to 3% due to currency depreciation.
Right.
So there are instruments which are in the market which can be used to hedge currency risk. There are currency ETFs in market as well. Okay, especially in US market. Okay, that can be used. Positions can be taken there. To protect against the risk. Options and futures which are available. There's some cost to it. Definitely. There's some cost to it.
But it's worthwhile to add that to the.
So basically, if the cost is, let's say, it is costing you more than 3%, 2 to 3%. I take the 2% as a threshold.
Okay.
If it is costing you more than 2% of the portfolio value for the year,
Okay.
You should not go for hedging.
Okay.
If it is below that, then it makes sense to go for hedging.
Right.
Okay. Second thing is you can also diversify using the gold.
Okay.
You can go long on gold futures. Okay. Gold is practically a currency hedge for India. Gold has been a very good, even in domestic investors use it as a currency hedge. Okay. So gold futures, you can people can take equivalent long positions in gold futures, which are trading on NYMEX, in US, and they can hedge against the currency depreciation.
Right.
Currency depreciation risk right now is a real risk across economies.
Right.
Even in US, people are giving extreme scenarios. Some people are saying US dollar index will go to 120. Some people are talking about 70.
Exactly.
Okay. So we don't know where it is. So fiat currency is anyways under attack.
Right.
Okay. People can either take the USD INR, they short the USD INR, contract. Okay. They can take some positions there, or they can go for gold derivatives as well. That's one more.
So Karan, the currency risk aspect is pretty clear. So that makes sense. And that is, like you said, it's applicable for anyone outside of India trying to invest here. But when it comes to NRI specifically, that is actually a slightly different use case when it comes to a normal foreign investor here, right? And how does that factor into this?
See, a normal foreigner, an ordinary foreigner citizen who is not having any ties with India
Right,
on either
right,
parent side,
right.
okay, they have to take exposure to India through funds listed in their local market.
Right. Okay. Okay.
So it's mostly a diversification,
Right. Story.
angle that is
Yeah.
there, diversification story. So like we invest in Hang Seng ETF
Correct.
in India,
Correct.
or in Nasdaq ETF in India.
Yeah.
Okay, there's no deeper US story. There are very few options which are out there apart
Correct.
from a plain
Correct.
vanilla exposure.
Right. Right.
NRI has access to entire market,
Okay.
all the products which are available there.
Right.
Okay.
Right.
So they have the capability to capture true essence of Indian market. They can actually outperform a normal foreign citizen when it comes to Indian market by a good decent margin.
Right.
Okay.
Right. Right.
So they can look at different mutual funds which are out there.
Right.
They can look at the PMS which are out there.
Right.
EAFs out there.
Right.
Different categories, capturing different opportunities. Factors, factor alpha.
Correct.
Sectoral themes. Okay. Micro cap, multi-baggers, decadal
Right,
stories.
right.
They can look at Indian market in a, they can slice and dice Indian market in a way
Right.
that is impossible for a normal foreigner.
Foreigner. Okay. Okay.
So that's the advantage or
Right.
edge
Right.
an NRI or PIO
Right.
has when they are basically when they are investing in India. Okay,
Right.
they can take direct stock exposure. Okay, they can do the proper sizing. You know what I'm talking about. Like
Exactly,
you are investing in
exactly.
US, there are a lot of
restrictions.
lot of restrictions which are out there. US restrictions are less. Let's say you're investing in China.
Right.
Let's say you say
exactly.
that China is the next global growth engine.
Correct. Correct.
And I want to invest in China. There are very few options.
So
which
in
are
essence, you're saying that for a normal foreign investor who's not a NRI, for them, the India story can only make sense at a maximum at a diversification level, right? Because there is no other option that is available for that investor to actually enter the Indian market in a deep way. But whereas an NRI, because the rules governing that framework are much different, they can add the India story in its true essence. Like they can truly benefit. So it almost kind of compensates for the currency risk that they are actually running.
Yes.
Okay.
It's
okay.
I would say it kind of cover to some
Covers,
extent.
yes,
Cover
yes.
for some extent on the currency risk.
Right.
That
right.
are covering. It might cover, might not cover.
Right.
Okay. Yeah, but there is that is one additional driver that can help them negate that.
Negate that. So Karan, now for any NRI investor who is now convinced by the India story and they're looking to either enter the Indian market for the first time or maybe increase the exposure to the Indian market right now, I want to talk about specifically the offering and the differentiation that we bring to the table compared to, like in a very objective manner, compared to the options that an NRI will have for other products as well. So we are 100% factor-based investing. Our model is based on that. We are also 100% rule-based, and we also do tactical quants.
Yeah.
So given the kind of system we run, I want to give a very objective perspective to the NRI in terms of what we bring to the table compared to the other options that might be available.
Santosh, most of products which are out there in the market are built on philosophy of old school stock picking.
Stock picking,
okay,
correct.
Which is designed to create alpha by capturing or exploiting, we can say, market anomalies.
Correct.
But the problem is, as happened in US in 90s, okay, markets generally become efficient with time.
Correct.
Okay. And as they become efficient, these market anomalies, they disappear.
Start disappearing, yeah.
Okay. They are there, but they are very rare.
Very rare.
Very rare. Okay.
Right.
So US has already gone through that cycle. Okay.
Which means to get the same alpha, you have to increase your risk.
Yes.
Right.
Okay.
Right.
So in India, what is happening? It's starting disappearing from large cap in 2010s.
Right.
Okay. It's right now in process of disappearing from mid caps.
Wow.
Okay.
Okay.
So you can say that alpha is largely absent in top 300 companies. Okay.
Okay.
So if you want to move beyond a standard India ETF,
Correct.
okay,
Correct.
something different, you have to go in riskier segments of the market, like micro cap.
Micro caps, small.
Okay.
Yeah.
And considering the NRIs and PIOs, they live outside India, it's very difficult for them to evaluate
Right.
what are their holding about their holdings, because research coverage is very
poor. Yeah.
beyond 300 companies. Okay. So what factor investing is doing, it's basically trying to create alpha over the market or the broader market, okay, in general using quant-based models in the mid-cap and large-cap space only.
Okay.
So
Okay.
when you invest, when you are going for a micro cap style returns,
Right.
okay,
Right.
you are not taking that company specific risk that comes with a micro cap holding, okay, or a fund which is concentrated 80%, 90% in micro cap on micro cap
Right.
side,
Right.
okay, because most of the holdings are 90%, nearly 80 to 90%, we can say, or the product mix that we create for client, nearly 90% that is in large cap and mid cap space, which is very well covered.
Okay.
Investors can actually analyze their holdings, okay,
Right.
and they can form opinion on that as well.
Right. Right.
Okay.
Right.
So that is the differentiation that we are bringing to table. Good part is that factor investing is still in nascent stage in India.
Right.
Okay.
Right. So alpha is available there.
Alpha is available. As NRIs who are living in US for last 30, 40 years or investing in US market for a few decades, they would understand that as soon as you identify a factor or factor gain widespread acceptance, alpha disappears.
Right.
Like happened with value after
Correct.
.com bubble.
Correct. Correct.
Okay. But in India, the story can still be leveraged
Right.
for next 10 to 15 years because
Right.
most of the investors are still few years away
Right.
from moving away from, we can say that standard stock picking strategies.
Point number one, like you mentioned, one of the main ways in which we differentiate is because we focus on this nascent stage of factor investing, where alpha is actually still available, whereas it is disappearing from the traditional style of stock picking in, say, mid cap, large cap, and all of that. So while we are still in that space itself, which is reasonably stable, but we are giving that alpha potential using the factor
See, the
investing.
thing is that if you want some alpha that is not associated with standard India ETFs listed
Right.
on NYSE, today you have to go to a riskier segments in the market.
Correct.
Okay, with factor investing, we can deliver that
In the
while
stable
restricting
segment.
exposure to
Smaller,
relatively
mid-cap
safer,
and,
safer segment of the market.
Got it, got it. But now we don't just stop there, right? Now we also follow, using our quant model, we also do factor rotation. Can you talk a little bit about that as well?
See, in general, factor investing has worked very well in India in last 20 years.
Right.
Forget about our models for a minute. Let's look at models developed by NSE. Okay. Even those models, if you look at the backtest history of 15, 20 years,
Right.
they've outperformed the benchmark comfortably.
Comfortably, yeah.
Okay. But the problem with factor investing is that every factor has different story.
Right.
Okay. So like, low volatility dividend, that typically works very well. Their alpha is maximized. It's outperformance of a benchmark. They maximize during the bad times.
Correct.
If you look at, momentum, alpha, small cap, there the outperformance is maximized during the bull time.
Bull time.
But if you are in wrong factor at wrong time, it can damage you badly.
Right.
Okay, for example,
right.
if you are in momentum, let's say from 2007 to 14, your returns are negative.
Negative.
Where FDs were returning 60%. So an investor would definitely revisit that. 5 to 7 years is a decent.
It's a
long
decent
period,
timeline,
isn't
yes.
it? So what we are doing in tactical allocation, we have a tactical allocation model
Right.
that basically take 5 inputs. Okay, based on those 5 inputs, we basically take a call, a medium to long term, whether it's going to be bearish phase, bullish phase, or market consolidation phase, and accordingly factors are selected.
Right.
Okay,
Right.
so we have our own factor portfolios. Based on this tactical model, factor portfolios are selected. So
Right.
it's like fund of fund approach,
Right.
but it's a fund of Elever factor portfolio.
Elevers only.
So
Right.
the idea is to create an all-season alpha.
Right, right. And all of this we do again based our 100% rule-based system. So there is no human bias. We completely negate that from the picture also, right? Sure. So that was essentially a perspective, especially for our NRI clients and even our potential NRI clients who are looking to India as a way to kind of add to their portfolio or increase their exposure to the portfolio, and how we could probably add value to that particular exercise. If you have any further questions, you can also leave comments or you can reach out directly via our website. Once again, thanks, Karan, and hopefully people found that useful.